This conference will now be recorded.
So once again, there'll be one grade for the yellow team, one grade for the blue team, and one grade for the red team. And that's based on the number that are presented. These are journal entries. So these journal entries will be presented starting on Tuesday. Because when you present, your cameras have to be on. So we have to get all those cameras on today, on Tuesday. If you're presenting, your camera has to be on. Okay, so and we have been very successful, I think, at this point with our goal for the course, which is to teach you how to prepare an income statement, a statement of retained earnings, and a balance sheet. That was our goal, to teach you how to prepare an income statement, a statement of retained earnings, and we went through the accounting cycle to get there. We got another statement that we will work with at the midterm. So we got those statements prepared. We need to begin to pull our theory into the course now. And we have generally accepted accounting principles called GAAP, and they're formulated by 4 organizations: the Securities and Exchange Commission. That's the legal organization that is responsible for the regulation, generally accepted accounting principles. Because people will do a lot of fraudulent things. If there are no principles out there, they just do things so they look good. So after the Great Depression, the Securities and Exchange Commission was created. Now, in effect, the Financial Accounting Standards Board does most of the work, so it's sort of delegated it to the practitioners who are going to have more expertise in developing the principles. For governmental regulation 84, we have the Governmental Accounting Standards Board, because what municipalities began to go broke in nations because they didn't have generally accepted accounting principles. And so we have the Governmental Accounting Standards. And then finally, we have the IASB, the International Accounting Standards Board. It's not enough just to have standards in the U.S., but because U.S. companies operate internationally, we got to have uniform standards internationally. And so the IASB is the International Standards Board. They're London-based, setting standards for the whole world. And FASB is they're working together to make sure we have a uniform set of standards nationwide. Otherwise, you cannot compare companies and determine whether they are profitable or not. So you of course should know those 4 governing boards for creating accounting principles. There are 15 generally accepted accounting principles that you need to know. Now, I won't test you on these until after midterm, but there are several of these that are important now as we work into adjusting entries. First one is the recognition principle, which states that companies reveal their income and expenses in the same period in which they were accrued, not paid, but when they were accrued. So if you remember on that journal entry 15, even though the work had not been done, the income was recognized because the earning process had been completed. So we're already working with this recognition principle. Then we have 8, the matching principle. The matching principle states expenses should be recognized and recorded when those expenses can be matched with the revenue, when they can be matched with the revenues. So if we have revenue, the expenses need to be matched with them. If not, you're going to be taxed on revenue higher than what you should be because you didn't recognize the expenses. Let's look at this example. Workers are paid monthly, and a company's year end is December 31st, and these workers are going to be paid on January 1st. In December, 400,000 in revenue was generated. 400,000 was generated, and the workers earned 75,000, but they would not be paid until January of 2021. And so, if that were the case, we'd have this revenue 400,000. We wouldn't have the expenses, and so we'd pay tax on 400,000 when we should have only paid tax on 325. And so, if we recognize the revenue, all the related expenses need to be recognized, and that is, the main purpose of adjusting interest, to make sure we got that revenue recognized with Type 15 journal entries. We got to now pull in all the relevant expenses. And a final concept that we're looking at, accrual basis, which is summarizing what we just talked about. Accounting reflects transactions and other events when the earning process has occurred, not when receipts and payments occur. So we recognize revenue and expenses when the revenue has been earned and when the liability for the expenses has been created. And so that's what we've been doing. We have not been recognizing expense, even though in general, when we looked at expenses, we did, they were generally paid. But if there were expenses that have been incurred that have not been paid, then we got to recognize them too. We got to make journal entries to do that. So expenses, just like revenue, are recognized when incurred, not when paid. And so we're going to see that. And so you should be familiarizing yourself with 14, 8, and 7. No, 14, 8, and 6. So 6, 8, and 14, read this. It's in the primer, and we'll go back over it. But this is the background for adjusting entry. This is the background for adjusting entries. Okay.
You posting that to Blackboard?
I posted it to my primer. It's in your primer. Let's see if I can get it where I need to be. Let's see. And these two people who made my life so miserable, I had two people and they were back to back. They didn't have the same exam, but they were back to back. And they sent me 60 pages to grade. They sent me 60 pages. And the name of the journal, the account would be on one page and the number on another page. So they got to resubmit. sent me 60 pages. And it's late, I'm tired. But they decided they would send me 60 pages. Okay, let's see if we can get where we need to be. But I think it's a record for me, but I think approximately 20 out of 25 people passed. So that's exceedingly good. That's exceedingly good. But now we're into something different called adjusting entries. And sometimes adjusting entries give people problems. The reason for that is that with adjusting entries, you will not be given a dollar amount, okay? You're not going to be given the amount of the entry. You got to calculate it. So heretofore, all you had to do was to go around and figure out the type of journal entry it was. And let's see. And that made it pretty easy to work with. But that's no longer the case. So let me just see. My computer is acting up a little bit today. It does not want to act right. I'll just have to do it manually. I'm trying to get back to the accounting cycle. Okay. So let's look at this accounting cycle. And we did steps 1 and 2, where we analyzed transactions and we made journal entries. Then we did steps 3 and 4. We posted to the ledger and we prepared a trial balance. Then we skipped steps 5 and 6 and went on to steps 7 and 8, which was to, from the trial balance, prepare financial statements and make closing entries. Now we're coming back to steps 5 and 6. So that's where I was trying to get to, where you got to make adjusting entries. Now you don't have to do step 4. You will have a trial balance, but it's going to have some more journal entries in it. It's going to have the regular journal entries, but it's going to have what's called the adjusting entries. So they're simply adjusting entries with debits and credits that have to be equal, and you have to post them. So whenever we have adjusting entries, there's nothing to be afraid of. They're just journal entries, but you got to post them. You must post them. Okay, so let's see if we can get to these adjusting entries today. And I apologize, my computer, it must need an update or something. Okay, so let's talk about adjusting entries. And we just talked about the rationale. income statements have got to report revenues, losses, and expenses, revenue that's earned, losses incurred, and expenses incurred during the accounting period. And receivables and liabilities have to be accurate. And the types of adjusting entry: accrued revenue, accrued expenses, deferred expense. Deferred revenue, we have depreciation, and we have doubtful accounts and bad debts. So several types there as we'll go through them. Now, before we go any further, we're just going to look at a simple example about the rationale for an adjusting entry. And when we were doing the demonstration of making journal entries on pages 37 and 38, we had two entries where we purchased supplies. Take this out for now. We had two entries where we purchased supplies. In the first entry, we debited supplies and credited cash for $1,000. Then in the second one, we debited supplies for $8,000 and credited accounts payable for $8,000. So at this point, we have in the supplies account $9,000. Okay, based on these two adjusting entries. But we go through and we determine, when we take an inventory, we only got $3,000 in supply. So that's the key here. Supplies is showing up as $9,000, but supplies have been used during the year. And when we get ready to, when we do our inventory of the supplies, we now only have $3,000 in supplies. This is where the adjusting entry comes in. If we had $9,000 in supplies that we bought, but when we get to the end of the year, there's only $3,000, what has happened? What has happened? If you had $9,000 in the bank at the start of the year and you only got $3,000 at the end, what happened?
You must have spent your money or something. You losing money.
Spent your money. Well, that's why you earn it to spend it. So we had, how much did you spend?
$6,000.
Spent $6,000. So we don't want to show 9,000 when we don't have 9, we only have 6. So here comes the adjusting entry where we're debiting supplies for 6,000, supplies expense for 6,000, and we're crediting supplies. See, every time you buy an asset, it eventually turns into an expense. So it needs to be generating revenue. So businesses don't buy things unless it's going to generate revenue, because the supplies expense is going to end up on the income statement. So this is the journal entry we make: debiting supplies expense for 6 and crediting supplies because we only have 3,000 left. Now we're going to post this entry. So we're going to credit supplies now for 6,000. And we're going to debit supplies expense for 6,000. So yeah, it is an adjusting entry, but at the end of the day, it's a journal entry with a debit and a credit that are equal that you have to post. But I did not tell you the amount you had to calculate. I did not tell you the amount. Okay, you have to calculate it. So does everyone now see why we need adjusting entries? Everybody have a sense of why we need adjusting entries? Okay. Let's look at the types of adjusting entries. The main one are prepaid expenses. You bought the item, it's an asset, but it's utilized. Then we have unearned revenue. Unearned revenue is the very nice situation where you're running a company and people pay you before you've received the revenue. They pay you before you've received the revenue. And so we're going to work on prepaid expenses and unearned revenue today. Prepaid expenses and unearned revenue today. Then we'll go over the entries on it that you're required to make on Tuesday. Once these entries are made, we'll talk about accrued revenue and accrued expenses, and then we'll make that set of journal entries on Thursday. So Monday, prepaid expenses and unearned revenue. On Thursday, accrued revenue and accrued expenses. So you should be able to tell where your journal entry is. Let's look at some important rules for adjusting entries. Cash is never involved in the adjusting entry. And I'm going to say it a second time. Cash is never involved in an adjusting entry. And I'm going to say it a third time. Cash is never involved in an adjusting entry. Now, it may have been involved in a preceding entry, or it may be in a subsequent entry, but cash is never involved in the adjusting entry itself. Secondly, an adjusting entry is always going to involve an income statement account and a balance sheet account. An adjusting entry is always going to involve an income statement account and a balance sheet account that is not cash. So let's go back up here and look at our adjusting entry on supplies. When we bought the supplies, we paid cash. We're going to eventually pay off this accounts payable. These are what's called preceding entries, prior to the adjusting entry. But when we make this adjusting entry, I do not want to see cash in here. Is that clear? When it's AJE, when I say make it AJE, I do not want to see cash. Okay. And the second part of it, it has to involve an income statement account and a balance sheet account. What's the income statement account in this AJE? What's the income statement account? What is the income statement account?
Would it be AJE?
Nah, I said that's the AJE. Then I got two accounts, 684
Oh,
130.
that's called expense.
Which one is an income statement account and which one is a balance sheet account?
Supplies expense.
Is a what?
The income statement.
Supposed to be telling me.
Yeah, the supplies is the income statement and supplies is the balance.
That's correct. Do I have that here? see if I can come to that quickly. You got your chart of accounts. And I guess I have it here. Balance sheet accounts and income statement accounts. And I probably will put this chart in this format because it's telling you for the different types of AJEs, telling you what accounts are involved, and we'll see that. And here, whereas I summarize, let me put those in there.
Hey, Professor,
Yes, sir.
is this PowerPoint or thing available on Blackboard for us?
It's in the primer. I'm just talking straight from the primer,
Okay.
which you supposed to buy. If you haven't been to the bookstore, go. So that's the thing, you know, it's here. You're not taking notes. It's in the primer. You can read ahead, read along. But you need to get that. It's a copyrighted book, so I put some of it in, but I can't just put copyrighted things in Blackboard. Got it? So even though it's my book, it's copyrighted with the publisher. So I, periodically put pages in, but I can't put it in. And the primer was done because, puts everything in one place for you. To spread it all over Blackboard everywhere was not, not a good way to do it. So former students said, write a book, Dr. Boyd, and put it all together. So I spent my long hours writing this book. And as I say, I do not get paid. These are my notes. So I didn't do it to make money. I did it so I could teach more effectively. So you could see it. So you don't have to take notes. You got the primer, you can follow along, unhighlight or whatever, and understand it. Okay. The first type of adjusting entry see if I can find it. Unearned revenue. So the first type of adjusting entry is unearned revenue. And I think these are the easiest. Unearned revenue occurs when a company receives cash prior to the performance of the services or the delivery of the goods. The company has cash, but it has not done the work. So there's a preceding cash entry, but when we get ready for the adjusting entry, we don't want any cash. Airline companies make you pay in advance, magazine and publishing companies. And then sometimes shoe companies, game companies like GameStop will make you pay in advance. A game is coming out with limited edition, so assume GameStop collects $50 in advance from 200 customers for a game that will arrive in 2 months. People got to have this game. It's only 200 coming to the store. The people pay in advance. GameStop's very happy. So GameStop is going to make an entry. What's 50 times 200? Is that 10,000? Is that 10,000? I'm assuming it is. They're going to make an entry, debiting cash and crediting unearned revenue. What kind of an account is unearned revenue? Looking at your chart of accounts, where do you see unearned revenue? If you look closely, you'll see that it's a liability. When a company gets income in advance, the revenue is unearned because they may not deliver. People may want their money back. So we debit cash and credit unearned revenue. It's a liability, which they may have to pay back. Now, 2 months later, the gain comes in, all the customers pick up their gains. Here comes the adjusting entry. Debiting unearned revenue, crediting sales. Okay. Debiting unearned revenue, crediting sales. So this is one of the easier adjusting entries. With any adjusting entry, we're going to post. So when the money came in, we would have credited unearned revenue. When we make the adjusting entry, we see unearned revenue is a liability. Sales is a revenue. And so we're happy that it's unearned. And then we're happy when we get the items and the people pick up the gains, but we happy anyway because we got the money ahead of time. And so when we make this AJE, we're going to now debit unearned revenue. And we're going to credit sales for 10,000. Now, what type of journal entry is this? Which number is this? If I told you journal entry type, what would you tell me?
Would it be a type 4?
Type 4. That's what's here. Type 4.
Motherfucker.
So now we're using type 4. We're debiting cash and crediting unearned revenue. And then when the people pick up the gains, we debit we're going to debit unearned revenue and credit sales. So now it can go on the income statement. When it's unearned revenue, it's a liability and it's on the balance sheet. But when we make this adjusting entry, it is now on the income statement. So notice here, a balance sheet account, unearned revenue, a liability, a credit to sales, which is an income statement account. Are there any questions?
Professor Boyd, I noticed that AJE is using type 20. Are we gonna like expand the types that we're using?
All of them now.
Okay.
You're responsible for all of them. And I think I added one the other day, so I'll give you an updated list. But now you're responsible for all of those types of entries. Okay, so for adjusting entries, people who've been assigned with teams, if 22 to 24 is in your color, that's where we start next time. We're starting on 22 next time. Got it? So what team has those? I guess y'all figure it out eventually. Okay. The next set that we want to look at these prepaid expenses. Most assets are prepaid expenses. You buy the asset, but it's going to become an expense. And it needs to be bought so that it can generate revenue. So there's always a prior entry when we buy the asset. And cash may be involved or accounts payable, but eventually we got to pay the accounts payable. Prepaid expenses, they can expire with the passage of time, such as prepaid insurance, or through usage supplies. So it's two ways they move along. If you don't make the adjusting entry, just like with those supplies, the assets are overstated and the expenses are understated. If you don't transfer out from supplies or any other asset account, the asset is overstated, expenses are understated. So the revenue is overstated. So we got to make an adjusting entry. We're going to debit an expense account and credit the appropriate asset account. Let's start with supplies. I expect all students to be able to do supplies and prepaid expenses. So here, assume supplies of $5,000 of purchase during the period. Pay cash for. Supplies $5,000, credit cash $5,000. We come to the end of the period and there are only $2,000 in supplies left. Now you could have expensed them day by day, but that doesn't make any sense. To make a zillion journal entries every time you use a paper clip. And so we buy the supplies, we put it in the asset account. And then when we come to the end of the year and determine what's left in the account, which is $2,000, then the AJE is always the difference between what was in the account and what's left. It's always the difference. That's how much was utilized. Are there any questions?
So when we need to do when we need to do the AGEs or AJEs, will they always come with like an explanation with it, like the paragraph above?
Mm-hmm.
Okay.
But I won't tell you the dollar amount.
We'll have to figure it out.
You got to figure it out.
Okay.
Your rest period is over, where you didn't have to think. So all you have to do is go to type. I had the dollar amount. So on a couple of those A exams, we got them ready for the real world of accounting. So, but most of the transactions, you do know the amount, but you'll have a paragraph like this all the time. So you see it in those the journal entry study problem 3-1. So for journal entries 1 through 6, you all are up next time also. So the team that has 1 through 6, those journal entries are up. Okay. We have $2,000 in supplies and let's see. And let's assume this is 2020. So when we get to the end of 2020, let's see. We got $2,000 in supplies in 2020. Okay, so we get into 2021. And we buy some more supplies. My account's sticking out. So we buy some more supplies. And let's just assume that in this year, we bought $8,000 worth of supplies. Okay. Okay, so we bought $8,000 worth of supplies. And then we come to the end of the year, darn, we come to the end of the year for 2021, and the balance in our supplies account is $4,000. So that's the balance in the account. We know what the AJ is going to be. We know the journal entry. But what's going to be the amount in 2021 when we make our AJE?
Would it be 4,000?
Okay.
6,000.
Okay, so we would have gone on in 2021, we would have had an expense account, 3,000, and we would have closed this out with a closing entry. Okay. So that's 2021. Now we're ready for the 2022. So what's going to happen in 2022? I mean 2021. When 2021 gets here, the 2,000 that was in there at the end of the year is going to still be in there at the beginning of 2021. So the 2,000 is still there. We bought 8,000, right? So in the account now is what? $10,000. We need in the account, it says 4,000. So what's our AJE going to be?
6,000.
6,000. So, you know, with your bank account, whatever you got in your bank on December 31st becomes the beginning amount on January 1st of the next year. So as you begin to work those supplies, AJEs, they're going to say, okay, you know, include the beginning amount in there, okay? Are there any questions on supplies? How many people got a car? Anybody here have a car? Have a car?
I do.
You got an insurance on your car?
Yeah, I do.
Uh-huh. Since you have insurance, we'll let you work this next problem for us. No, everybody else, you know, if they have cars, they don't have any insurance on you. They're just driving. They hit you, you're in trouble. Okay, so we buy insurance because we got to protect fire, theft, loss, all those type of things. So when we buy the insurance, it's a type 7. So let's assume we bought a 1-year policy for our business and it was $24,000. So we bought a 1-year policy. We buy this policy on April 1st. Okay. So when December 31st comes around, we're saying, okay, we bought it on April 1st for $24,000. It's an asset. The amount that's expired, we need to put that in insurance expense. So even though we paid $24,000, time has occurred, and a lot of the insurance now has expired. So what we're going to do? How much insurance is gone? If you purchased insurance on April 1st, first of all, it's got a 12-month policy, and the cost of $24,000. That should tell you it's expiring at what rate?
2,000 per month.
It's expiring at $2,000 per month. So that's the first thing that you should realize, that it's expiring at the rate of $2,000 a month. So I'll just put the 2,000 here. And how do we get 2,000? we just simply took the 24,000 and divided by what?
12.
Okay. So that's how we got 2,000. So right now we got 24,000 in here as of April 1st. Okay. But how much is left in this account? How much is left in the account?
6,000 is left.
You said 6,000. How you get 6,000?
Because you bought it on April 1st and it's December, you spent up 9 and you only have 3 left. So what's left over is just 3 months, and 3 times the 2,000, which is a month, is 6. Right?
Sounds good to me. So how much is the adjusting entry then?
It would be 18,000.
18,000. 9 months have gone by. And so we just multiply 9 times 2. And so our adjusting interest. So when we post this, we're going to have a credit to prepaid insurance for 18,000. We're going to have a debit to insurance expense for 18,000. Any questions? So these are simply adjusting interest.
How do we get to 18,000 again? I missed that part.
We simply counted from April to December, and since it was April 1st, that was 9 months. And then we multiplied that by the 2,000 per month that was being utilized. Got it?
Yeah, I do.
2,000. So you count, first of all, you figure out the amortization rate per month, dividing whatever that life it is into, if it's 6 months, if it's 6, into the total cost. So that tells you it's expiring at the rate of 2,000 a month. Then you count how many months have gone by and multiply it by the monthly expiration amount. Are there any questions? So we will at least do journal entry 7 and 8 next time also, for whoever that first team is. Is the team ready? Good. Are there any questions?
Just to be clear. Sorry, go ahead.
Next to my name on like the chart with the groups, I don't have a number by it. Is that for a reason?
I guess, who is this, Hicks?
Yes.
I probably just left it off accidentally. I'll find one for you though. What team are you on? Which color are you at?
Hold on. Blue.
Where am I? Okay, yeah, that was just probably an oversight. Okay. So we'll just put 33 by you.
Okay. Dr. Boyd,
Yes.
is the groups on Blackboard?
Yeah, I posted this in Blackboard.
Okay.
See if it's in there. Typically, if a person doesn't have a number, they didn't take the exam or something, unless I just left you out. Remember, I'm only giving that group 1 grade.
And then where are the journals we're supposed to be doing? Because we just see there's just a submission AJE, but there's no journals.
It is in the primer on page 84. Starts on page 84 in the primer. Any other questions? So now we begin, a different part of the course where we begin to work in teams. And so, you go to work, you're not going to be working independently. You're going to be working as a team. So sometimes you have to help the team members out if they don't understand what they're doing. And what you will find is that when you help someone, you'll learn it better. So to be able to help somebody, it helps you in terms of learning it better. And I got to find my future Joy, darn, since Joy is graduating next spring. So I got to audition you all.
Dr. Boyd?
Yes.
Where would it be on Blackboard? I don't think I see it.
I think it's supposed to be an assignment. Did anybody see it?
I see the AGE journal entries, but I don't see the document for the groups.
Spreadsheet didn't come?
No, sir.
Okay, so